Welcome to the Explainer. Okay, today we are diving into a really fascinating breakdown of a high-yield alternative ETF that's been generating a ton of buzz lately. We're looking at OVL, which is an exchange-traded fund that basically tries to thread the needle between pure market growth and high monthly income. But right off the bat, just a quick, super important note before we start clicking through the data. The source material for today's analysis was actively sponsored by OVL's issuer, Liquid Strategies. Because of that, our job today is to objectively break down their claims. Look strictly at the mechanics and the data they've presented, and do so without taking any sides at all. We are just here to understand exactly how this financial machinery works.
We've got a highly structured journey ahead of us. We'll be hitting 1. The investing battle, 2. Introducing Etf Ovl, 3. The covered call baseline, 4. The put credit spread, and finally, 5. A reality check on returns versus risks.
All right, let's jump into Section 1, the investing battle.
It's literally the ultimate question when you're building a portfolio, isn't it? Do you prioritize long-term growth by just holding stocks forever, or do you desperately need those monthly dividends rolling into your account right now to help pay the bills? It all comes down to your specific goals as an investor, but historically, choosing one usually means totally sacrificing the other.
And this comparison brilliantly illustrates that classic trade-off. When you look at the metric of total returns, growth almost always wins. Why? Well, because its upside isn't capped. If the market goes on an absolute tear, growth captures all of it. On the flip side, traditional income strategies give you that immediate, satisfying cash generation, but they very often cap your potential gains in exchange for those payouts. You get the cash today, sure, but you're leaving a lot of potential money on the table tomorrow.
Moving on to Section 2, introducing Etf Ovl.
So OVL is aiming to find a real balance between growth and income. It does this by getting its underlying exposure to the S&P 500 through the massively popular VOO ETF. So underneath it all, you're tied to the top 500 companies in the US. But then, and here's the twist, it strategically layers a really unique option strategy right over that foundation.
And here is the hook. A massive distribution rate of 10.29%. I mean, a double-digit yield like that is exactly the kind of magnet that immediately catches any high-yield investor's eye. It is custom-built to generate significant, heavy cash flow.
However, you know there's always a catch, right? That yield comes with a cost, an expense ratio of 0.79%. Now that's quite a bit higher than your standard, passive growth funds, which might charge you literally pennies, like 0.03%. But in the income-generating world, actively managing complex options takes a ton of time, effort, and expertise, and all of that drives up the management fee.
But honestly, investors really don't seem to mind the price of admission. The fund's net assets under management are nearing $300 million right now. It is showing rapidly growing popularity in the market. But to truly wrap our heads around why it's so popular, we have to understand exactly what it's doing differently behind the scenes.
Which brings us to Section 3, the covered call baseline.
Okay, let's step through a traditional covered call together. It's generally considered a neutral to slightly bullish strategy. Imagine you own 100 shares of a stock at $100 per share. To generate income, you agree to sell a call option at a higher strike price, let's say $105. Just for making this agreement, you instantly collect a cash premium up front. In this specific example, $1.50 per share. The really beautiful thing for the investor is that premium hits your account right away.
So, the crucial takeaway here is this specific trade-off. You profit nicely if the stock stays below that $105 mark, but if the stock skyrockets to, say, $120, your profits are strictly capped at $105. You are completely locked out of any massive market rallies. And to make matters even trickier, you still hold all the downside risk if the underlying stock just totally crashes. So you get the yield, yeah, but you give up the big runs.
Let's move right into Section 4, the put credit spread.
So instead of those covered calls, OVL uses a totally different strategy called a put credit spread. This is also a neutral to bullish strategy, but the mechanics are completely flipped. Here, you're dealing with puts. You buy a put down at $95 for protection, and simultaneously, you sell one at $100. That combo drops a net credit of $1.20 right into your pocket, totally up front.
Now, the beauty of this spread is your max profit zone is achieved as long as the ETF simply stays anywhere above that $100 strike price. This structure offers a much more defined risk profile. But most importantly, it theoretically lets the fund capture way more upside if the market goes on a massive run, totally sidestepping that severe capping issue we just saw with the covered call.
Section 5. Reality check. Returns versus risks.
Now for the really fun part. The data. Check out this total return comparison since inception. And by the way, this data strictly factors in that 0.79% expense ratio we talked about earlier. In this specific time frame, OVL delivered a total return of 195.12%, actually outperforming the baseline S&P 500 ETF, the SPY, which sat at 176.69%. I mean, getting both a high yield and beating the S&P 500 in total return, that is a super rare combination, and it perfectly explains why this fund has so much hype right now.
But we've got to balance that excitement with a serious reality check about a concept called NAV erosion. Literally, neither strategy can completely prevent this. NAV erosion is this relentless force dictated by unpredictable macro market movements. If the underlying asset drops consistently, the fund's net asset value erodes, period, regardless of how clever or complex the option strategy layered on top of it might be.
Because of how that put-credit spread is built, when the market takes a sudden sharp dive, OVL can actually take a harsher immediate hit than the standard S&P 500. Like during the drawdown in October 2023, OVL experienced a very noticeable pullback. It's a stark reminder to investors that you are paying a premium, 0.79% fee, but you are still deeply exposed to severe market volatility. There is absolutely no magic shield against a falling market.
Which brings us to our final big question for today's explainer. Having objectively broken down the actual mechanics of these competing option strategies, you really have to ask yourself, how do you value this trade-off? Is the complex machinery of high-income generation worth the higher fees and those unique downside risks? Or is the straightforward simplicity of pure market growth still the ultimate winner for your portfolio? It's a tough question, but it's one every single investor has to answer for themselves. Thanks so much for joining me to unpack all this, and keep learning.